I'm Darius McDermott of FundCalibre. Today I'm here with Torcail Stewart, co-manager of the elite-rated Baillie Gifford Corporate Bond Fund.
Good morning.
Your fund is called Corporate Bond, yet it sits in the strategic bond sector. Why is that sort of naming anomaly on the fund?
Indeed, what's in a name? Our corporate bond fund is a strategic bond fund in all but name, and its rather straightforward name is really part of its genesis. It was the first corporate bond fund that we launched back in 1999, and since its inception it's been seeking to deliver a high level of monthly income by allocating between investment grade and high yield bonds, and we vary that allocation up to a maximum of 50% in high yield.
And how do you decide whether to be more in high yield or more in investment grade, or even maybe government bonds?
Yes, well really it's a tripartite approach. So we look at three information feeds. The first one is looking at market valuation, the second is macroeconomic environment, and the last one is stock-specific risk return. Macroeconomic environment is simplistically looking at our top-down view of the market and what are the leading indicators flashing red, green, amber. Market valuation is looking at how does sterling investment grade compare to dollar investment grade or euro high yield versus dollar high yield. And finally, stock-specific risk return is when we think about stock X, Y, and Z, looking at its valuation of those stocks within the fund, how does that compare to the fundamentals that we know that business very well, and then using that as a barometer to extrapolate back to the overall market. So it's a tripartite approach. We vary the amount in investment grade and high yield so that we can deliver a high level of monthly income through the cycle.
Yet you don't use government bonds, gilts, in this fund.
No, well we actually do use lend to government bonds. So if we feel that market valuations are looking or markets looking too expensive, or that macroeconomic risks are rising, then we will seek to reduce the amount of longer dated, lower rated corporate bonds that we lend to, and instead replace them with gilt futures. So in an indirect manner we do lend to sterling government bonds. At the start of this year, as macroeconomic risks were rising, we decided to increase the amount of gilt futures within the fund.
Where then, for the year ahead, do you see the best opportunity in the broad fixed income spectrum?
Over the last year, what we've seen is a great amount of concern regarding sort of negative interest rates and their impact upon bank profitability. So we have seen a number of bank bonds fall materially in price, but that negative sentiment has also spread across to the insurance space, where we've seen a number of insurance bonds, high quality, or we believe high quality insurance bonds, fall in price. Now, whilst we believe some of that concern is justified for the likes of Eurozone life insurance companies, we don't feel it's justified for some of the more diversified UK and US non-life insurance businesses. So we're finding a lot of interesting opportunities in those sectors. Beyond financials, within the oil and gas and emerging markets, we have seen a lot of fear within those sectors, and generally when you get fear in a sector, you see a lot of the strong quality issuers falling in price along with the sort of weaker issuers. So we are seeing quite a lot of opportunities there. Overall, macroeconomic concerns are causing a plethora of attractive valuations to appear within the market. So our pipeline of new ideas is very healthy. Also, a number of our high conviction positions have fallen in price over the last year and are on higher yields than last year.
Torcail, thank you very much.